You think your stop loss is protecting you. It might be feeding someone else's trade. In an algorithm-driven market, an obvious stop is not a shield. It is a data point. Institutions do not need to see your order. They only need to know where thousands of traders like you are likely to place theirs. Institutions don't need to see your order. They just need to know where traders like you place theirs. I focus on trading reactions, not news. If you trade leaps, this matters more than you think, because you can be right about the company. You can be right about the next 1 or 2 years, and you can still get stopped out at the worst possible moment. Today, I am breaking down why that happens and how to fix it. Hey, welcome back. If you are new here, I trade leaps, long-dated options. I do not trade the news. I trade the reaction. And one of the biggest mistakes I see leaps investors make has nothing to do with picking the wrong company. It is placing the wrong kind of stop. Let's get into it. Here is the setup. You find a company you believe in. Strong earnings growth. AI demand. Cloud expansion. Margin improvement. You buy a leaps call, 1 or 2 years out. Then you do something that quietly breaks your own thesis. You place a stop just below the nearest daily support level. Now think about what just happened. Your investment thesis is built on a multi-year story. Your exit is built on a single day's chart. That is a mismatch. And it is a common one. Retail traders tend to place stops in the same handful of places, below the previous daily low, below a round number, below the 50-day moving average, below an earnings gap, below recent breakout levels, below popular trend lines. These are not hidden. They are visible to everyone. Algorithms do not need a secret list of your stop orders. They just need to study price structure, volume, volatility, and options positioning. When enough traders lean on the same level, that level stops being a safety net. It becomes a liquidity zone. So, how a liquidity sweep hurts leaps investors. Here is what a sweep usually looks like. Price approaches a major support level. Buyers get cautious. Liquidity thins out. The stock dips below support. Stops trigger and convert into market sell orders. Short-term traders pile on. Option prices drop as fear increases. Then, once the panic selling is absorbed, the stock recovers. It moves back above support, and you are already out. The thesis is still intact. The company is still growing. The stock recovers within hours or days. But you sold at the exact point of maximum short-term pressure. This is the most frustrating outcome in trading. You were right about the company. You were wrong about the structure of the trade. Part 3. The leaps stop-loss problem. A leaps contract does not move like a stock. Its price is shaped by the stock price, time to expiration, implied volatility, delta, interest rates, earnings expectations, and overall market conditions. That means a fixed percentage stop on the option premium can lie to you. A leaps contract can drop 20%, while the stock only drops 6 or 7%. That is not proof your thesis failed. The extra drop might just simply reflect temporary market volatility, a drop in implied volatility, a sector pullback, an earnings repricing, short-term underlying weakness, broad growth stock declines. If you set an automatic stop at 15% below your purchase price, normal volatility can knock you out of a position that is still perfectly valid. This risk gets worse with lower delta contracts, shorter expirations, and high implied volatility. Part 4. Manage the thesis, not the option. Before entering a leaps position, it's crucial to manage the thesis rather than the option itself. Ask yourself, what would truly invalidate your thesis? A short-term dip below support is not enough to invalidate a long-term thesis. It's essential to differentiate between noise and real threats to your investment. Here is the question you should ask before you ever enter a LEAPS position. What would actually prove my thesis wrong? The answer is not, the stock dipped below support for 10 minutes. A real invalidation looks like this. Earnings growth breaks down, guidance gets cut, the company loses a major customer, free cash flow deteriorates, debt rises without better returns, a real competitive threat shows up, long-term weekly support breaks, the valuation stays excessive even after growth slows. Notice something. None of those are about a 5-minute candle. They are about the business. Part 5. Noise versus real damage. Not every breakdown is a sweep. Sometimes support fails because the market is correctly pricing in bad news. The skill is telling the difference. A likely sweep looks like this: a quick move below support, a spike in volume, a long lower wick, a close back above the level, recovery within a day or two, no real change in the fundamentals. A real breakdown looks like this: repeated failure to reclaim the level, several closes below it, weak earnings or lowered guidance, heavy institutional selling over multiple sessions, a break of weekly or monthly structure, a change in fundamental story. One candle should never decide the fate of a 1 or 2 year thesis. Confirmation matters. This is the same discipline behind what I call the patience test. Wait for the market to show its hand before you react to it. Part 6. A better LEAPS entry strategy. Instead of buying right at support and placing a tight stop underneath, let the market prove itself first. Step 1. Know the thesis. Why is this company worth more in 1 or 2 years? Step 2. Know the valuation range. Falling is not a reason to buy. The expected return has to justify the risk. Step 3. Mark the liquidity zones. Previous lows, earnings gaps, long-term moving averages, round numbers. Step 4. Wait for the reaction. Let price test or briefly break the level. Step 5. Look for confirmation. A reclaim, improving volume, a higher low, a reversal candle, strength coming back into the sector. Step 6. Scale in. You do not need the full position at once. 1/3 near the first confirmed support. 1/3 after the stock reclaims a key level. 1/3 once the trend starts improving. This is a version of what I call the A+ setup applied specifically to entries. You are not trying to catch the exact bottom. You are trying to avoid committing everything before the market has finished repricing. Part 7. Smarter risk management for LEAPS. Skipping a tight stop does not mean skipping risk management. It means matching your risk tools to a long-duration position. Position size comes first. If a normal correction would wreck your portfolio, the position was too big from the start. Contract selection matters. A delta near 0.70 to 0.80 behaves more like the stock itself. More time to expiration gives the thesis room to play out. Staggered entries protect you from assuming the first dip is the final bottom. Fundamental exit rules mean you reduce or exit when the business story changes, not when the premium dips. Technical confirmation means using the weekly chart for a long-term position. A daily breakdown can be noise. A sustained weekly breakdown is a different conversation. Time-based reviews mean checking in after earnings, guidance updates, product launches, or shifts in industry demand. Part 8. Now, let's discuss when a hard stop still makes sense in your strategy. I want to be fair here. Tight stops are not always wrong. They can make sense if the position is speculative, if the fundamentals are already weak, if expiration is close, if the contract is deep out of the money, if you entered purely for a short-term catalyst, if you genuinely cannot tolerate a large drawdown, if the thesis depends on one single event, if your overall portfolio is already overleveraged. The key is consistency. If you entered this as a one-year investment, do not suddenly manage it like a 2-day trade the moment volatility shows up, and do not rename a speculative trade an investment just because it started losing. Part 9. The real institutional advantage. Institutions are not better because they can hunt your stop. Their real edge is more patient capital, better risk models, more complete data, less emotional pressure, the ability to scale in slowly, and a clear line between trading and investing. Most retail vulnerability is self-inflicted. Position too large, contract too aggressive, entry too close to earnings. Stop placed exactly where normal volatility can reach it. The goal was never to outsmart every algorithm. The goal is to stop being forced to sell during temporary volatility. Part 10. Your 2026 LEAPS Protocol. Before you buy a LEAPS contract, run through these questions. Why will this company be worth more in 1 or 2 years? What price represents fair value? What fundamental event would break the thesis? What weekly chart level signals real technical damage? How much can I lose without hurting the portfolio? Am I buying enough time? Is the delta high enough? Is implied volatility reasonable? Am I entering right before earnings or another catalyst? Can I scale in instead of buying it all today? These questions matter more than any stop-loss percentage you could pick. Your stop-loss is probably not being personally hunted, but an obvious stop, sitting below a crowded support level, can become part of the liquidity that fuels a short-term move against you. For a LEAPS investor, the real risk is not volatility. It is using short-term price action to manage a long-term thesis. A LEAPS position gets sold when the thesis breaks, not because the market scared you into it. So do not remove risk management. Improve it. Smaller positions, higher quality contracts, enough time, scaling into volatility, tracking the actual business, using the weekly chart instead of reacting to every intraday wick. If this helped you think differently about stop losses on your LEAPS positions, hit subscribe. I will see you in the next one.